My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramer. My friends, I'm just trying to make you a little money. My job is not just to entertain, but to educate, teach you. Call me 1-800-743-CNBC. Tweet me at Jim Cramer. Right now, it is time to retire the term beat and raise. It just doesn't really capture what's happening. In fact, it's throwing people off because it's too amorphous a concept. Now that we've effectively finished earnings season, I've been thinking about it. I've been thinking about what the takeaways are. You know what the biggest takeaway is? It's the way we report on stocks. All of us. It's not working anymore. It's failing us. It's too glib, too inconsistent, too unrepresentative of a company's worth. The reportage is causing people to make snap judgments that turn out to be false judgments. And it's got to stop. On the daily today, where the Dow slipped 23 points, S&P declined 0.17%, NASDAQ lost 0.55%. We got to pause. We got to figure out what's going wrong with the terminology, because we need a new approach going forward if we're going to be able to make money. Exhibits A and B against the current ways of reporting the breaking news surrounding Lowe's and Home Depot. And you know both of those companies. That's why this will be so cogent. When these fantastic businesses reported early morning, both were widely panned on multiple lines, especially their forecasts. Within a few minutes of the quarters, a bunch of outlets generated misleadingly negative stories. It was quite clear that some of them were the product of artificial intelligence. We're talking simple contrast without any regard for the myriad factors that contributed to the line items in question. These stories were not false, so to speak. They correctly compared the posted numbers with the analyst estimates. They failed to include even an iota of nuanced explanation, though, for what was described as a mess by the writers. Although, in fairness, the writers have to come up with something that describes the quarter or the future better. And you can hear that later in the show when we talk to Mark Benioff from Salesforce. Same thing happened this evening. What can I tell you? It no longer makes sense for us to try to capture the story by using this beat and raise concept. Now, what makes this so bad? Simple. The stocks of both Home Depot and Lowe's have simply been rocket ships since they reported. I mean, straight up. The exact opposite of what you would have thought of when you read those stories and those headlines that came out instantly. That's why I am so upset about this. The best you can say, I guess, is that the negative headlines gave you a terrific buying opportunity. As the stocks fell quickly off these misleading stories, you can argue that those who sold deserve to lose money because they didn't wait until the conference calls, where they would have heard multiple positives about how these two well-known home improvement retailers were doing, and they are doing terrifically. Yet the headlines this quarter have almost been universally wrong, unless it's something incredibly clear-cut like an NVIDIA, where the numbers are so much better than expected that it was actually obvious. Let's tackle what went on here at Home Depot before getting to Lowe's. First, you learned why the stock went up, not down. In the fourth paragraph of the CEO, Ted Decker's opening remarks, not in the headlines, but in the conference call. Not in the earnings release, but in the conference call. Home Depot has been dogged by excess inventory in 2023, and excess inventory puts pressure on pricing. Now, Decker says, quote, "We feel good about our inventory position heading into 2024, end quote. There, that's it. That's all you need to know. That's the most important controllable part of Home Depot's earnings trajectory. It's from inventory. If you have too much stuff, then you need to discount it, and that's what actually causes shortfalls. Too little, and you can't meet demand. At the end of the quarter, Home Depot's merchandise inventories were $21 billion, down $3.9 billion, or approximately 16% versus last year. You see, that is sensational. That was the metric. Now that Decker says the inventories are clean, that means no promotions, which translates into positive quarters in the future. In the forecast, they will be better than were expected until now. So what happened with the quarter that's caused the so-called shortfall that the articles heralded? Well, for that, we have to listen to the Executive Vice President of Merchandising, William Bastek, who quoted, and I'm just giving you to right from the conference call, unfavorable impacts from weather in January, end quote. That threw things off. That's relatively unimportant because Home Depot is not a traditional retailer. Their Christmas occurs in the spring gardening season. The cleanup of the inventory situation will allow them to bring in full-price goods to meet the spring demand. That's why it's going up. Weather? Yeah, real problem. But fault of their own? Yes, if it hadn't been impossible many days in January to build in this country, those numbers would have been really strong. Try summarizing that in a headline. Try to summarize -9 in Kansas City when my team was there and did cover that football game. There wasn't a lot of construction going on at -9. Home Depot also boosted its dividend by 7.7%, something that the traders who dominate all the stock market discourse simply don't care about. Investors do. Traders are in and out. They don't even get the dividend. How about Lowe's? Here was a quarter that the headlines made out to be extremely disappointing. I mean, like this kind. With a slowdown cited for do-it-yourself renovators, the most important part of the company's customer base. Again, though, the problem was the weather. January same-store sales declined at an amazing 7.4%, but it was weather. CEO Marvin Ellison told you the professional numbers were flat, which, unless you know the company, wouldn't matter. It's real important, though, and again, contrary to what was expected. William Boltz, this time the executive vice president of merchandising, pointed out that building products were terrific. Quote, this was our best performing area with positive comps in building materials, end quote. That's paint, that's drywall, that's roofing, all doing well. Big margin items. And Lowe's is adding a loyalty program for the spring. It's called My Lowe's Rewards, and it'll be available nationwide in March, just in time for gardening season. That's meaningful stuff, not captured. It's why the stock keeps going higher. Okay, now that we know things were actually good, not bad, the headlines were wrong at Home Depot and Lowe's, what did we learn that made both of the stocks reverse and fly higher beyond this? I think it's the virtually unlimited amount of equity in homes. According to Home Depot's Ted Decker, 50% of homes are over 40 years old, prime renovation age. A ton of money's made from renovation at Lowe's and Home Depot. Fundamental housing shortage of between 2 and 6 million homes will keep those prices high. Sure, it would help if mortgage rates would come down, but Decker says it's more important that customers have, quote, tremendous potential in an untapped balance sheet and equity position, end quote. By the way, he's citing $10 trillion added just during the pandemic in value. Wow. Again, that's the stuff that tells me get long. You won't go wrong. And that's just exactly what investors did. It was a great buy point for both Lowe's and Home Depot, generated by the headlines. But you wouldn't know it unless you did your homework and had listened to the conference calls. Mad Money, there's always a takeaway. Today it happened again. It said, I think that the next rocket ship might be TJX, the off-price retailer behind TJ Maxx and Marshalls. Oh, you would know it from the headlines, which were dominated by a weak forecast. Not again like, what I told you about what's going to happen with Salesforce later on. That kept the lid on the stock. The headline writers don't know two things, though. First, the best indicator of what happens at TJX's stock is the availability of high-quality merchandise that they buy at insane discounts from cash-strapped merchants. And listen to what the low-key CEO Ernie Herman had to say about all important rhetoric. Quote, availability of quality branded merchandise continues to be outstanding, end quote. TJX is in a, quote, terrific position, end quote, to buy that merchandise. Later on, he continued, quote, at the end of the day, there's more goods out there than we can handle, end quote. The closure of 150 Macy's locations that we learned about the other day will be a bonanza for TJX. Still one reason why we own this one for the trust. So there's a lot of excess merchandise and the Macy's deal. They are going to be great. Here's the bottom line. I have no illusions about this issue. It's extremely unlikely that the headline process will actually change. The misdirection will continue. But my job is to entertain, educate, and help you make money. And the best way to do that right now is to do the homework, listen to the conference call, shoot against the headline writers. They're in such a hurry, they just can't get it right. But you, on the other hand, can take the time to understand the actual situation and make the best, well-informed, and hopefully most lucrative investment decisions. Clark in Maryland. Clark.
Come on, Clark.
Hey, Big Maryland.
Who's that?
Yeah.
Booyah!
My stock is TKO Group. That is the WWE with Vince McMahon out and the new streaming arrangement for Raw. Are we going to the top rope or are we getting pinned?
Holy cow, that kid's got horse sense, doesn't he? I'll tell you, this is a tough one, and it's involved with Endeavor, which is really hard to understand. All I can tell you is that I think that the stock has come down so much. And I know, just so you know, I know from people, I will go as far as to say, who first told me that this one was great? Why don't we just use like Strauss Zelnick? He said that WWE is great. I've seen it. I know how many people are excited about it. I got to tell you, it's down too much. I like the kid's attitude. Very positive attitude for the kid. All right, look, the headline writers are in such a hurry to jump to conclusions about a company's earnings report that they get it wrong. But if you take the time and you do the homework, you listen to the conference call, you will make money off their mistakes. Isn't that a great opportunity? Mad Money tonight. Salesforce turned in its quarterly report after the bell, and despite falling in the news, because of the forecast. I'm getting a sense of how AI is pushing the company to new heights with CEO Mark Benioff. Then a story you might have missed. Garmin reported a strong quarter that went seemingly unnoticed. I'm digging in to see how that's possible. I think this one can keep running. And what should you make of Salesforce, of Snowflake, given the quarter? All I can say is I'm blown away. We're going to speak to both the outgoing and the incoming CEOs at Snowflake. Holy cow, I got to process this stuff. Stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.